Debunking distaste for dilution. Now, what's dilution? So, stock dilution happens when a company issues more shares of its stock or when more shares materialize, such as when employees exercise stock options or grants. Remember that a company first issues stock to the public via an initial public offering IPO. After that, other issuances are called secondary offerings. Companies will issue more stock for various reasons. They might, for example, need to raise money in order to grow their business in some way, or maybe to buy another company. Or maybe they're just running low on funds and needed to run the business. To raise the needed funds, they could take on debt or sell some assets, or they could issue more shares of their stock, which investors will buy. And so there's different nuanced examples on when a company may issue shares. It could be for a host of reasons. Though stock dilution looks negative at first glance, it can be positive if the company uses the additional funds raised in a way that creates greater returns for the company. So there are good ways to use stock dilution, all right? If you're trying to grow the company in a certain way and you don't want to use your cash, you can issue shares. And if you're on the right path, that's going to pay even better in the long run when you equate for inflation and whatnot. All right. And so for some gematria decodes, we have dilution, help a stock save money. That equals 333 in English ordinal. We also that also equals 117 in reduction. Penny stocks dilute to grow, and shares being issued by great stocks both equals 330 in English ordinal. You cast a zero off, that's 33. We have dilution for growth purpose and stock dilution for good purpose, both equaling 137 in reduction, which is the 33rd prime. Dilution helping acquisitions and a good stock dilutes protecting cash, both equal 133 in reduction. And for the big D code, a simple sentence: you issue shares of a stock to protect cash reserves. That equals 3,333 in Latin. And again, it's simple. Some companies, they will issue stocks on the open market to just protect their cash reserves. They might only have a certain amount of cash on hand, and instead of wasting it all to raise funds, they'll go into the secondary offering market. Again, if the management knows what it's doing, dilution could be a good thing. If the management doesn't know what they're doing, or they're looking just to make money off the shareholders and not provide any value into the company and stock, it could be a bad thing. So, even though you hear dilution online on FinTwit, Twitter, and social media, it's not always a bad thing. It can be a good thing.